IOUs to China, et cetera, or are they just numbers on a screen?
Yes, to all of those. It's all of the above and more.
And that's all considered monetary policy, not?
Well, some of it is.
Macroeconomics.
I have a chart which I didn't bring. It's the most amazing chart I've ever seen in my life. It's a chart of the monetary base, so you've got a time axis, and then you have an amount. Monetary basis, currency and bank reserves. And it was basically trendless for years. And it just goes up like this. It's now increasing at a 90%, 90% annual rate. So, I mean, this is the easiest monetary policy. I mean, you got to go to Zimbabwe to get something worse.
I mean, isn't all this Egyptian money for zero crying about liquidity and credit markets, isn't this all just going to result in huge rates of inflation?
It will, but not right away. The first thing that we're up against is in this weak economy is we've got deflationary forces at work, and they will probably be at work for the next year. But after about pushing down prices, it's most visible in commodities. Oil prices are collapsing. Commodity prices are collapsing across the board. Agricultural commodities is going to be a big bust in the heartland of America because the agricultural commodities, the prices are collapsing. Ethanol firms are going under, and the value of agricultural land will start to fall, and agricultural land is pledged as collateral for loans, so you're going to have a whole new hit on the set of banks that lend to agriculture.
So why are they decreasing?
Well, because of the globally slowing economy.
So everyone's anticipating less demand?
Well, it's reality. I mean, it shows up in a lot of ways. Basically, the Chinese sell us finished goods and buy commodities to produce those finished goods, and China is slowing. The rates, the index that measures the rates for shipping is collapsing. The cost of shipping is collapsing because much less is being shipped. These are all indicators of global weakness in economic activity. But a year from now, yeah. 3 years from now, yeah, we're going to, unless the Fed reverses policy much faster than I know it is going to reverse policy, inflation will be a problem. You had a question over here.
How do you know when inflation is starting? What do you look at as indicators?
There's no one indicator that's reliable. Right now, I'll give you two. One indicator is the value of the dollar. Right now, the value of the dollar is rising because the U.S. is a safe haven. The dollar is a safe haven. We have managed to export all these problems. The European banks actually have been hit as hard or harder by this crisis because they bought a lot of this paper. So right now there's a flight to quality, which means treasury bills and the dollar, because you need dollars to acquire treasury bills. So right now the dollar is strengthening. When it starts to turn around and weaken, that would be one indicator. When what is called the yield curve, there's no, it's jargon. It's, if you look at, okay, origin down here, and you look at terms to maturity, and you start with 1 month, and you go out to 30 years. The yield curve is the curve that shows the interest rates for different maturities, beginning very short term, going out to 30 years. When that steepens, that's a sign of future expected inflation. Right now, gold is collapsing like every other commodity, and the reason all commodities are collapsing, aside from the slowing global economy, which means that you don't want to buy and stock up on oil and other commodities because if you expect in the future their price will rise. So again, like the subprime story, as soon as you stop thinking the price of a commodity will rise, all the speculative activity leaves. Now, it leaves violently because all of these plays, all of these bets on commodities, I don't care what it is, corn, oil, steel, gold, are done with borrowed money and everybody's deleveraging. Everybody needs to pay their loans off. You pay your loan off by selling the thing you borrowed to buy. So the near term, we have severe deflationary forces, and long term, we're going to have serious inflationary. What is long term? Not for a year probably, maybe not till 2 years out, but certainly then. And when the gold starts to come back into play as an inflation hedge, when people start borrowing sums of money again to buy gold, then that would be another indicator that we're at that tipping point.
In your experience, you mentioned that obviously the interest rates have been far too low, artificially low for a number of years. Looking back to the early 80s when interest rates were outrageously high, where is the, from a banker's perspective, where is that sweet spot? What makes sense to money lenders?
Bankers make money on the spread. That is the difference between the cost at which they borrow and the cost at which they lend. Normally, bankers borrow shorter term. Think of deposits. They have a lot of deposits that are either demand deposits or money market deposits or short-term, say 6-month certificates of deposit, and they lend longer. They buy securities, they make loans, they make industrial loans that don't pay back for years, they make car loans that take 3 years, or they buy the securities into which these are securitized. If the rate if the yield curve is positive, that is, the shorter term interest rate is lower than the longer term interest rate, that's generally a good thing for banks. In the early 1980s, the Fed jacked up interest rates because inflation was in double digits, and I think the short-term interest rates got over 20% at one point. I know my first mortgage was 13% or something, and in that environment, a bank can't make money. It bleeds money. It hemorrhages money because it's the price, at which it's borrowing is higher than the price at which it can lend. It's called an inverted yield curve. The short-term interest rate is high, and then the longer-term interest rates are lower, and that's not good for banks. Now, right now, the yield curve is steepening. It may be the early signs of inflation, but it's steepening, and that will help banks to return to profitability. Not right away.
Instead of a gold standard, couldn't they simply stop printing money? Wouldn't that be just as good?
Sure. That's the theory of fiat money or having a central bank and a control of money stock. In principle, you could have more stability than under a gold standard. But then you have to come up with this public choice analysis of, let's see if I have the quote from Anna Schwartz, this public choice analysis of commercial banks. Of central banks. What are they responding to? Well, if you seem to be creating perpetual prosperity, like it seemed to be true under the latter part of the Greenspan era, it's nice when you get called up to Congress and the congressmen line up to sing praises of you. It gets, it goes to your head, even leaving aside whether there's a deeper public choice connection. But Anna Schwartz was interviewed, and I quoted her on this very question. And she responded, in general, it's easier for a central bank to be accommodative, to be loose, to be promoting condition that makes everybody feel that things are going well. And I think it's the human element that's the problem in central banking. Human beings want the easy way out. They want to be like whatever.
At this point in time, it seems there are kind of two paths we can go down, one of which seems the one they're headed toward, which is basically not to end up like Japan in the 90s, which my understanding is that has to do with the velocity of money flow. And at the same time, in Japan, they printed gobs and gobs of money from a surplus to this massive deficit, but their currency remained relatively strong. Interest rates were low, they fought inflation. We seem bound and determined to somehow fix the money distribution system. And if indeed we succeed doing that, avoid the Japanese fate, it seems that, like you said, the prospect of inflation is very high. But what do you do now if you're looking at that saying that looks pretty likely? And rather than engage in productive economic activity, you say, well,